I'm here today with Sebastian Lyon, who's the founder and chief executive of Troy Asset Management and also the investment advisor to the Personal Assets Trust, which is in our investment trust portfolio and which an awful lot of readers hold in their own portfolios. Now, this has been a trust that we've been great fan of for a long time, but one that hasn't been a great contributor to the portfolio recently. So the first thing I want to ask you, Sebastian, is this is a trust that is designed to preserve capital over the long term.
Yeah.
It's doing that at the moment, but in the process, it's underperforming quite a lot of the rest of the market.
Yeah. Well, we've had a rather dull time for going back to 2000 and the end of 2012. Having had a very good crisis, we had a good 2007 and 8, and then had a good recovery.
Should we start at the beginning then? What was that good crisis based on? What were you holding that other people weren't?
Well, we had reduced our exposure to equities going into the crisis. We didn't necessarily see the crisis coming, but we saw a crisis coming, not necessarily the one that actually presented itself. We had a lot of fixed interest. This is obviously prior to my management of personal assets or investment advice of personal assets. This is purely in the Trojan Fund. We had fixed interest. We had a lot of overseas currency going into the crisis, which obviously, with sterling being particularly weak in 2008, was very helpful. And our equities were very defensive. So that all helped and actually led to us producing a very, very slightly positive return in 2008, which obviously was particularly unusual, being a long-only fund, not being able to short. As we came out, we shifted our equity allocation more positively towards the equity market in late 2008 after Lehman and early 2009. So we captured quite a lot of that upside. And in particular, as we got into the latter part of 2009, we recognised that while there had been a sort of dash for trash and as sort of the banks, which had looked as if they were insolvent, came back from the dead, which we didn't necessarily capture, there were quality stocks that were left behind, things like Nestle, Coca-Cola, Colgate-Palmolive. And these businesses were actually on the lowest ratings they've been on pretty much in my career. So they were very, very attractive as very high quality equities, cash generative businesses with good long-term dividend track records. Exactly the kind of stocks that we want in our portfolio longer term. And so we benefited, I think, from particularly during the difficult years of 2010, 11 and 12, where there wasn't normalization of interest rates, where obviously we had the euro crisis. Those sorts of businesses perform very well within the equity market. And actually, to be fair, have carried on performing okay, with the exception of 2013. I think from just going back to your point about the recent performance, which is really the last couple of years, I mean, our share price has bubbled along sideways. Now, one thing, fortunately...
Sorry, can I interrupt briefly just to ask, because we've talked about the Trojan Fund and now we're talking about personal assets,
but
effectively they're run in roughly the same way.
Yeah, and the returns are very, very similar. Last year, I think the total return of personal assets was 10% and the Trojan Fund was 9%. So, I mean, they're
and the
Trojan
Trojan
Fund,
just for watchers who don't know, is basically the flagship fund of Troy Asset Management.
Yes, yes, it's the one I've been managing since, open-ended fund, which I've been managing since 2001. So, that's our long-term track record. So one of the things I was going to say was that since our share price has been, our performance has been dull since sort of effectively since the beginning of 2013, so the last couple of years or so, at least we haven't had the problem which a lot of investment trust shareholders have of when there is a lull in performance, discounts start widening out. And one of the things which I know you're very familiar with is that we have a discount control mechanism so that if shareholders are want to realise their investment, they can do it at within 1%, 1 or 2% of the NAV. So we haven't gone to a discount, which is at least a small comfort, but nevertheless a comfort.
And have you had to buy back a lot of shares?
No, we haven't. No, not really. We bought back a few shares, probably. I'm trying to think of the exact amount, but really it was a few percent. In the latter part of 2013, when markets were really, really strong, and when our performance was particularly marked in terms of what we were doing compared to other people. And that was when we did a little bit of buyback. We did a few buybacks into really between October of 2013 up until February of 2014. And actually since then we've just been issuing shares a little bit again. So no, it's not really. Which I think tells you that, as you said at the beginning, I think our shareholders know what we're trying trying to do.
Yeah, you have a very loyal shareholder
Yeah.
base. Yeah. So let's just go back to this underperformance.
Yeah.
Sorry to
Yeah.
say that word.
No,
but
no, no,
underperformance over the last couple of years.
Yeah.
That's been based on what?
That has been based on really, it was really a period for about 15 months from the fourth quarter of 2012 to really the end of 2013.
Mm-hmm.
Actually, last year, the markets were actually flat and we were actually up 9 or 10%. So last year was sort of okay, but effectively we were getting back what we'd lost in 2013. So the damage was done essentially in those sort of 5 quarters, and really it was a few factors. Firstly, our defensive higher quality shares, like the ones I mentioned earlier, really didn't do very much.
Well, they're very expensive by now.
Well,
so
yeah, exactly. They were pretty fully valued by then. But also there was a feeling at that time, particularly when Mario Draghi stood up and said, "I'll do everything it takes to save the euro." I think there was a feeling of huge relief, normalization. The crisis was over, not just obviously the financial crisis, but the European crisis, and particularly cyclical stocks, house builders, banks, etc., did very, very well during that period. And these are companies which we don't hold, pretty much on principle. We don't hold those. We don't play the cycle from that perspective. We like to buy and hold.
No cyclical stocks.
Not really, not very capital intensive. I mean, I haven't owned a house builder or a retail bank for 13, 14 years. So yeah, no, there are some parts of the market which I just won't go to. I can assure you that not owning a retail bank in 2008 was a very good thing. So we don't. There are parts of the market that we don't own. So on a relative basis, some of our stocks were very dull. But the most important thing and the biggest contributor, and the one that you'll be most familiar with, Marion, is of course gold, which we've owned since 2005, which has done our portfolios. It's been very helpful as a diversifier. Gold obviously had a very big correction in 2013, falling from $1,900 to pretty much $1,200, where it sort of pretty much is today, and that lost us quite a bit of capital in the short term.
How much of the portfolio was in gold?
So the portfolio was at the peak. The portfolio was about 14% in gold. Today it's about 10 or 11. So we haven't actually sold any, but clearly it was a pretty uncomfortable experience, and that was really one of the things that did the damage, along with gold miners, which we've always had a relatively modest exposure in gold miners. Our bias has been much more towards bullion, fortunately, and much less towards the miners.
And that's still the case now.
And that's still the case now, very much so. In fact, actually, we've got less mining exposure now. We've only got about 1% mining exposure.
And why is that? Why bullion rather than miners?
The reason why we don't like the miners, and we've always been rather nervous of the miners, we've always had a sort of rather sort of nervous relationship with them, is coming back to the kinds of companies we invest in. And the kinds of companies we invest in are essentially companies that pay us to own them. They're cash-generative businesses that pay dividends or that buy back their stock, where the valuation is relatively straightforward to calculate, where one can look at free cash flow yields. If you look at a company, for example, like Newmont Mining, which we held for a long time with success and latterly less so, which ultimately we've sold, the returns on capital over the last 5 years have been about 2%. And it's been investing really, really hard. Over 100% of its pre-tax profit has been invested in that business in order to get a return of, well, not more than cash, but very, very little. And so that's the reason why we've always had a much more of a bias towards bullion.
You and I generally agree on gold,
Yeah.
but what are the main reasons why you keep holding this pretty hefty position?
Yeah, it is a hefty position. I think that you need, when you've got an insurance policy, you need it to pay out. I mean, there is no point in having 1% of your portfolio in an insurance policy. If things are going to get very difficult, as they did during the crisis, and I think as and when it happens, the next crisis will be different. It will be less about credit so much as more about money itself, which we can come on to. But I think that you want to have a meaningful commitment rather than have none at all. I think that from the point of view of why we still own gold, I mean, the first thing is one of the things that is put up against gold is, well, it's an opportunity cost. You can keep your money in the bank. You can earn interest. Well, actually, you can't
can't
do that anymore. In fact, it costs you money to keep Swiss francs in the bank or keep Danish kroner in the bank. So that argument has dissipated, and I think that clearly what has happened since 2008 is we've gone in for an era of we've called it a phony financial world, but effectively an era within finance where effectively monetary policy has become totally sort of unhinged and unanchored, and those risks, if anything, for me, have been increasing rather than decreasing. So while there was always the expectation of normalization of interest rates, here we are 6 years after the crisis, after interest rates were slashed to zero in the UK and in the US and elsewhere. We haven't had normalization of interest rates. And if anything, interestingly, over the last 6 months or so, we've gone further into unorthodox monetary policy. So not just in Japan and in Europe, but you've seen countries which had more normal interest rates, Australia, for example, Canada, Sweden, actually cutting rates as their economies have deteriorated. And so actually we're heading into a world of greater unorthodoxy, and I think there's greater need for that protection.
Okay, so when you say that you expect the next crisis to be not about credit but about money, what does that mean?
Well, essentially what we've had on an ongoing basis since 2008 has been sort of serial debasement. We called it a relay race to debase. There's always someone who's got the baton. At the moment, it's obviously the Europeans and the Japanese, but earlier in the cycle, it was much more about the Americans going QEs 1, 2, and 3, and the UK obviously much more in the earlier part of the cycle between sort of 2009 and 2012, when effectively the UK banking system was effectively being put on more of an even keel. So the baton has moved on, but it's still ongoing, and I think that there is a concern, particularly, I mean, if you look at what's happening in Switzerland, where people are actually paying money to have money on deposit in the bank, which is something which is pretty extraordinary. I mean, it has happened once in 1979, but very, very briefly in Switzerland, but you've now got it in Denmark as well, and maybe that will begin to happen in other countries. We will see. So this is unprecedented is a word that's been used far, far too often within this world that we live in. But it is unprecedented. And where will it end? And I haven't seen the likelihood of normalization of interest rates anytime soon. And so we're on this series of debasement and debasement. And I think that is when you can have gold, which historically has been money, where it can't be printed, where supply is actually very tight, then I think to have some sort of protection is for insurance within the portfolio is extremely important. I mean, one of the things that concerns me just at the moment is clearly with those interest rate cuts and with what's happening in Europe is that we are now, whereas people have been talking about a bond bubble for many, many years, we are now, I think, unambiguously in a bond bubble in certain markets in Europe where you've got negative nominal yields. You are in a situation where you're investing. People who are buying bunds, 5-year bunds or whatever, negative yields, are buying it on the basis of a greater fool theory that they're going to be able to sell it on.
Because there isn't any other way to make money.
Yeah. Absolutely. Yeah. I mean, it's pure speculation. Yeah. And so, all of these signs, they're not really signs of health within the system.
Not at all. So recently you've cut the equity exposure in the portfolio.
We've been reducing the equity exposure. Yes, because coming back to your comment about those stocks are expensive, we are concerned that stock markets are now unambiguously expensive, as not as expensive as perhaps historically bond markets have been, but it is harder to find cheap quality good stocks than it was in 2009, 2010. So we have been increasing liquidity. Okay, and where does that go? That goes into T-bills primarily. Goes into T-bills. Yeah. Obviously temporarily, with the idea that we anticipate that we will be able to invest at better levels sometime in the future. Okay, so it worked very well for us in the mid-2000s, but obviously we've had to wait a little bit longer this time. Yes. Do you have any sense of how much longer you might have to wait this time? My instinct is it is building up ahead of steam. But people are effectively handcuffed volunteers within the equity market. If you want a yield, clearly cash is not the answer. Clearly, bonds are not the answer. So people are finding themselves having to buy and pay up historically high valuations in order to generate income. What concerns me within for example, the UK market is payout ratios. Company managements have recognised this. They've been rewarded for it. Payout ratios have gone up a lot, from about 35% to about 65% in the last few years. So there's only so far
that can
go on. So you're not going to see huge dividend growth from here. And there is a risk that those dividends will not ultimately be sustainable. So, I mean, we've seen obviously big dividend cuts during the crisis from the banks, but we obviously subsequently have seen dividend cuts from BP and from Tesco and from Centrica last year as well. So we're starting to see some cuts from larger companies, which I think is a concern. And the difference between valuations and earnings growth has not been very robust. So effectively, there's been this huge PE multiple expansion, valuation. Investors have been prepared to pay a higher and higher percentage of profits. Now we know that can go on. It happened in the late 1990s, particularly after the Alan Greenspan's irrational exuberance speech. From the end of 1996 to the end of 1999, we saw markets just have a huge PE multiple expansion in a period where profits actually weren't very strong. So we know it can carry on.
So this could be a really long wait.
It could be 2 or 3 years. It could, yeah. Absolutely. But I think that we're not going to start playing bubbles, and ultimately, what the end result is, which is huge capital damage.
Yeah. In the last Personal Assets Quarterly, Robin wrote that personal assets is either like a stopped clock that's right twice a day, or an amazing lily that blooms twice a decade. Yeah.
Yes, we bloomed fairly well in 2001, 2002, and we bloomed very nicely in 2007, 2008, 2009.
So we might have another 4 or 5 years to wait.
Well, hope not. It's twice a decade. Yeah,
okay,
not 4 or 5 years, but it was 2008. Yeah, you could have another 2 years of having to be patient. But I think that, Pat, we are patient. We've proven in the past that we've defended capital when it's needed to be defended. I think that the other point is that we're not going to decrease our equity allocation particularly aggressively from here, because we recognise all the points that you've made. And we are we have selectively shifted the equities a little bit. We've taken some profits in those very high quality defensives, which we referred to earlier, and shifted them into a few, just reduced risk effectively where we saw greater downside. And occasionally where there were stocks where perhaps they hadn't performed particularly well, particularly due to a strong dollar, particularly where there's currency translation and the share price had been very dull, there we've been allocating a little bit more capital into that area, where we've seen relatively better value at least, and better yields. But I wouldn't see us decreasing our equity allocation aggressively from here.
Okay. Sebastian, also in the portfolio, there's quite a big holding of index-linked gilt, right?
Yeah.
So long term, you're definitely expecting inflation.
Absolutely. I mean, I think that global debt has actually increased quite materially since the crisis. Everybody back in 2010 was talking about deleveraging. And what we've seen is quite the opposite of that. There's a McKinsey report out in February talking about deleveraging. No deleveraging yet, and I think the figures were that global debt has increased from something like 142 trillion to 199 trillion dollars over that 5-year period. So we've got to find our way out of this debt, because clearly it's incredibly deflationary and has huge sort of risk implications for the global economy, and it's like a sort of leaden weight keeping growth back, keeping spending back as well, and keeping investment back. So how are we going to get there? How are we going to actually delever? And our view has always been that the natural route out would be higher levels of inflation. Countries that can't print their own money obviously struggle with that, as we've seen with Greece. But in the past, countries that can print their own money have always ultimately inflated their way out. Now, clearly that has taken a long time, continues to take a long time. The sheer weight of that debt has meant that the deflationary forces have been incredibly strong. And our expectations have sort of changed and evolved over the last few years, whereby we think that, firstly, bond markets are, as I mentioned earlier, very, very high risk. So there was a time when you would have part of your portfolio, a defensive portfolio in bonds. now that they were supposedly the risk-free part of your portfolio. Now we view them as very high risk. Index links are more of a hybrid, whereby if fixed interest markets perform well, then they will perform respectively, which they have done since 2009. Not as well as fixed interest, but nevertheless they've been okay. If ultimately interest rates start to rise, and they start to rise because of inflation, albeit we think that will happen with a lag, then people will pay a premium for that inflationary protection. Having said that, our duration at the moment, so the life of the bonds, is actually relatively short, because we actually don't want to take too much risk from that front. So our duration is around sort of 6 years, which is on balance, it's shorter than it has been for a very long time.
Okay, but in an environment like this, how does deflation turn into inflation? Right, we've had a lot of money printing so far. It hasn't created inflation.
Absolutely.
What's the transmission mechanism?
And I think that what is going to happen, what I expect to happen, is that there will be a recognition by governments that it's not, that actually money printing hasn't really worked, that QE hasn't worked in terms of generating inflation. It worked sort of briefly here in 2000 and 2011. We got to an RPI level of, I think it was 5.6, thanks to the devaluation of sterling in 2008, 2009. But obviously that disappeared as we stopped printing money back then. So my expectation is that there'll be a recognition that it hasn't really worked, and that governments will have to take more direct action. So I'm not talking about helicopter money per se, but I'm talking about perhaps governments directing money into the economy, into infrastructure.
Directing what money?
Well, directing printed money.
Printed money.
But actually spent, because the problem has been that the printed money hasn't been spent. The printed money has gone into the financial system, and effectively it's gone into assets and and it's created asset bubbles. So it hasn't gone to where ultimately the money was intended to ultimately get to consumers and to companies, etc., to spend money, and so I think there will be more direct,
print money, actively spend it.
Yeah, and more direct spending, and actually that will be very difficult for markets, because all of a sudden, whereas you've had a period where it's been printing money has been very benign for markets, suddenly people will start worrying about those bond valuations. They'll start worrying about higher levels of inflation. And that's ultimately, I think the next crisis, will be more of a deflationary shock, but then after that, we will see rising prices as a way out ultimately of those very high levels of debt, which we still continue to experience.
And then
that is further down the track. That's probably in 4 or 5 years' time.
Yeah. And
then your index link will do very well within that environment, and you certainly don't want fixed interest. Equities will struggle, I think, within that environment as well to some extent.
Thank you very much, Sebastian.
I'm anticipating that there's going to be a run on cash, that people are going to want real cash. By real cash, I mean dollars.
You mean actual notes?
Pieces of paper.
Actual notes.
Pieces of paper, because the whole economy works on credit.